All right, today we're going to tackle a really fundamental question, one that's right at the heart of all international trade. So, when two countries trade, how do they actually agree on a price? It sounds pretty simple, right? But finding that perfect sweet spot, what economists call the equilibrium price, is actually a huge puzzle. The good news is, economists have two main ways of solving it, and that's exactly what we're going to break down for you right now. So, here's how we'll do it. First, we'll look at the two big tools in the box. Then, we'll zoom in on partial equilibrium for a close-up. After that, we'll pull back for the big picture with general equilibrium. We'll see how they both find that magic price, put them head to head, and then wrap things up with a quick quiz to make sure it all sticks. Sound good? Let's dive in.
Okay, first up, the economist's toolkit.
So, when economists want to figure out the price of traded goods, they have two main approaches. You can think of it like a fork in the road. On one side, you've got partial equilibrium, and on the other, you've got general equilibrium. They're two totally different ways to get to the answer, and each one is useful for different kinds of problems. All right, let's grab that first tool and take a closer look. We're starting with partial equilibrium. The best way to think about this is like using a magnifying glass. You're zeroing in on one single market and basically pretending nothing else exists. So if we're looking at, say, the coffee market, we're just going to ignore what's happening with tea or sugar or anything else. The whole idea rests on a big assumption that whatever happens in this one little coffee market won't be big enough to cause major ripples across the entire economy. So you might be asking, why would you want to ignore everything else? Well, it's because this focused approach has some huge upsides. For one, you don't need a ton of data, just the basics, trade flows, tariffs, that kind of thing. This lets you get super detailed. You can analyze something as specific as, say, brown rice, instead of a vague category like grain. And that precision helps you avoid a nasty little trap called aggregation bias. We'll touch on that in just a sec. Plus, the whole thing is just simpler. It's transparent, it's easy to do, and the results are way easier to explain to people. Okay, so what is this aggregation bias thing? This picture explains it perfectly. Imagine you group apples and oranges together and just call them fruits. Looking at the combined data, it might look like a tariff is causing a big economic loss. See that blue shaded area? But if you use a partial equilibrium approach and look at them separately, you'd see the tariff on apples didn't actually change anything. And there wasn't even a tariff on oranges to begin with. So the real economic cost? Zero. By lumping them together, you get a totally misleading picture. That's a mistake this focused approach helps you avoid.
But of course, there's a flip side. That intense focus, it's also its biggest weakness. When you look at one market in a vacuum, you miss all the knock-on effects, the chain reactions. If something changes in the steel market, you can bet it's going to affect the car market. A new policy could pull workers from one industry into another. Partial equilibrium is totally blind to all of these crucial connections. It's like looking at one piece of a puzzle without seeing how it fits into the whole picture.
So if partial equilibrium is our magnifying glass, what's the other tool? Well, it's time to put down the magnifier and pick up the wide-angle lens. Let's talk about the big picture, general equilibrium. Yeah, this is the whole shebang. Instead of just one market, general equilibrium tries to model everything, all at the same time. We're talking every single market, every industry, all the consumers, and how they all interact with each other. The goal is to see how the entire system finds a new balance point after some kind of shock or policy change. It's incredibly ambitious, super complex, but wow, is it powerful. Now, the key tool for making this happen is something called an offer curve. It's also known as a reciprocal demand curve, and it's a really clever idea. Basically, it shows how much of a good a country is willing to import in exchange for a certain amount of its export. It beautifully combines what a nation is good at producing with what its people actually want to buy. It's a single curve that captures a country's entire trading position. And hey, a little bit of trivia for you. This whole offer curve concept, it was brought into international economics by a couple of legends, Marshall and Edgeworth.
Pretty cool, huh?
Okay, so we've met our two tools. We know what they are. Now for the fun part. Let's see how they actually work. How do they find that equilibrium price we've been talking about? Let's start with partial equilibrium. This three-part graph might look a little intimidating, but it's actually pretty straightforward. Okay, look at panel A. That's nation 1. See that price, P1? At any price above that, they make more than they need, so they have extra stuff to export. Now jump over to panel C, which is nation 2. For them, at any price below P3, they want to buy more than they make, so they need to import. The magic happens in the middle, in panel B. It just takes Nation 1's excess supply and Nation 2's excess demand and puts them together to create the international market.
And here's the bottom line. Nation 1's extra supply becomes the world's supply curve for this good, and Nation 2's extra demand becomes the world's demand curve. And just like in any basic econ class, where do they meet? Right there, at P2. That's the equilibrium. It's the price where the amount Nation 1 wants to sell perfectly matches the amount Nation 2 wants to buy. Boom. Done.
All right, now let's switch to general equilibrium. The picture looks different, but believe it or not, the basic idea is the same. Instead of those supply and demand curves, we have the two offer curves we just talked about, one for Nation 1 and one for Nation 2. And the equilibrium, it's just where those two curves cross, right there at point E. At that exact spot, trade is perfectly balanced. What Nation 1 is willing to give up for imports is exactly what Nation 2 is willing to accept for its exports. Everyone's happy. Okay, so we've got two different models, two different fixtures, but they both get us to an equilibrium price. So which one's better? Well, if you studied any economics, you already know the answer, don't you? It depends. Let's put them side by side. Think of it this way. Partial equilibrium, that's your microscope. It's for when you want to do a deep dive on one single thing. It's simpler, it's faster, and you can get really detailed. General equilibrium, that's your satellite view. It's for understanding the entire landscape. It's way more complete, it captures all those feedback loops and ripple effects, but man, is it a lot more complex and difficult to build.
And this really is the key takeaway. It's why economists use both. If you need to know how a tariff on steel is going to affect, the wages of lumberjacks and the price of milk, you absolutely need a general equilibrium model to see all those connections. But if you just want to know how that tariff affects steel companies and car manufacturers, partial equilibrium can give you a really powerful, clear answer without all the extra complexity.
All right, you've hung in there through the theory and the graphs. Let's do a quick quiz to see what you've picked up. Ready? First question, which analysis focuses on one market at a time, ignoring all the interactions with other markets? Is it the microscope or the satellite view? That's right, it's partial equilibrium analysis. That's our magnifying glass, our close-up tool. Okay, question number 2. What do we call that key tool in general equilibrium analysis, the one that's derived from a country's production and preferences? You got it, the offer curve. All right, last question. If you absolutely need the complete picture, you want to see how a policy change ripples through the entire economy with all the feedback between different sectors, which model are you going to reach for? Yep, for that whole shebang, you have to use general equilibrium analysis. Nice work. Okay, let me leave you with one final thought to chew on. Real-world trade deals, they aren't just one big decision. They're negotiated product by product by product. So think about that. If you're a negotiator in the room, what's actually more practical? A massive, super complex general equilibrium model that tries to account for everything? Or the simple, focused, transparent power of a partial equilibrium analysis that gives you a clear answer for the one product you're fighting over right now? It's a really interesting question, right? That classic trade-off between being complete and just being practical. Something to think about. Thanks so much for joining me.